All right, welcome back, y'all. John here, and today we are going to talk about the most boring way, but the most effective, to build your way to wealth and a substantial, comfortable retirement, and that is index funds. Now, these are not sexy. I'm going to go ahead and tell you. This is kind of a set it and forget it method, which is exactly what you want. You know, when you invest and you have it coming out of your account every single month, you don't want to think about it, because when you start to think about that pile of money, it becomes awfully tempting to maybe go spend some of it, and you want to forget about it. So there's a lot of options when you go to invest. You've got mutual funds, you've got exchange traded funds, you've got managed funds, you've got, of course, buying individual stocks, and heck, I like that too. Grab my phone, hop on Webull, I can do my research, I can invest, and when you sign up for Webull, you can get 2 free stocks when you deposit your first $100, just like I have. And the best way is index funds. Now, there's a lot of regular investors that you can go find information, blog posts and videos where they've used index funds over a long period of time and invested, just dripped it in there month after month and built up substantial portfolios. But what's interesting is when you look at some of the top investors, some of the top money people who have, let's say, removed themselves from the sales side of it, right? They're not vested in selling you something. Once they get to that point, they tend to talk about index funds being the best for everybody. Now, if you go to Fidelity, Vanguard, Schwab, TD Ameritrade, there's tons of mutual funds out there. And the fact is, you can make it really, really complicated. If you want international technology companies that plant trees, you can find one, okay? But index funds are the simple, boring, drip your money out to them every single month. Now, this video kind of builds on my previous video, which is my 3-bucket strategy. And that is 3 different pots of money that you're sending your investment money to every single month. Now, of course, you've got to get your spending under control, pay down your debt, build up a little nest egg, but then you're going to start plowing money in for the future. And that's where I recommend you go with index funds. Now, a mutual fund is a collection of stocks, right, in a package. And they have to meet some kind of goal or some kind of objective. Again, an international technology mutual fund, a domestic technology and consulting fund, a white goods manufacturers, whatever it happens to be. There are hundreds and hundreds and hundreds of different mutual funds out there to choose from. And all of them have a manager or managers. And they're moving the stocks. They're selling and they're buying, they're adding, they're shifting it, and they're trying to beat the market. And that sounds great, right? But those managers want to make money, so they have to charge you an expense fee for it. So these managers are out there trying to beat the market, and the fact of the matter is, most times they don't. And you've heard the phrase before that past performance does not mean future results. And that's certainly the case here. If you were to say, I want to go invest $1,000, $3,000 into a mutual fund, and you look back at the top funds from the previous year, the odds are they're not going to be that great this year. And that the more time you look away, the less they beat the market. There was a thought, came out in, I believe, 93, there was a study that said mutual funds that did very well tended to do well. And the idea, I think, being that if you have a manager who picked a bunch of winners, the next year all he has to do is kind of get rid of the weak ones and try to add in some more hits. But they updated that study and looked at another 20 years worth of information and found out that never held true either. So let's take a look at a couple of facts here real quick. And the first is, I went through 3 different places, right? I went to Fidelity, Charles Schwab, and Vanguard, and took a look at their S&P 500 index funds. Now, again, my 3-bucket strategy, there's 3 different funds you would put your money into to try to capture the strength. You can find a total market index fund. So instead of trying to beat the market, just track the market. Now, your returns are always going to be a little bit less because you do have to pay an expense, even for these funds that are not actively managing. These guys just buy a package and basically leave it alone. So when you look at an S&P 500 index fund, they look at the Standard & Poor 500 stocks and they buy those stocks in that proportion. Okay? That's how they craft this index fund. And they end up being very, very similar. You're going to see that here in a second. But just to start off here, I'm looking at Fidelity, no minimum to invest, and expense ratio, there we go, of 0.015. Okay? Vanguard, S&P 500, they have a 3,000 minimum investment with a 0.04 ratio. And Schwab, you've got a 0.02% ratio expenses, okay? Now let's look at the results real quick. That Schwab over a 10-year period, it's getting 14.49%. The Fidelity is getting 13.9%. And the Vanguard is getting 13.88%. So there's not a huge amount of difference there between any of them in terms of their results, and not too much, you know, a 0.035% difference in the fees they're charging. Now for comparison, I picked another stock here from Fidelity. This is their Fidelity Blue Chip Growth Fund. You can see right here their expense ratio is 0.79%. So you'll often see mutual funds, their expense ratios are 0.75, 0.8, 0.83, 0.85, things like that. And it doesn't sound like a lot, but if you're talking about 0.02 and 0.8, it's a big difference. And the growth in the stock has to not only beat the market, what you're doing with an index fund, but also cover the extra fee they're charging you for it to make sense at all for you to actually do it. And again, over the long term, it shows it just doesn't happen. You know, this one particular and specifically, it has done a really good job. It's over 10 years, it's had a 19.12%. That's pretty impressive. But you're gambling. So why try to gamble? Why try to beat the market when you can just invest in the market? That's the power of index funds, is certainty, investing broadly, diversification across multiple different categories and business types, as well as extremely low fees. Because as much as I hate debt, man, I hate fees even more, which is why I bank with a credit union. So I hope this helps. That's the power of it. I encourage you. Hey, I'm going to tell you what, after looking at these, I think that Fidelity probably has the easiest website to go through. I admit I was pretty impressed with them. I did a video about my long-term plans for the channel, and as I grow, as I monetize, I'm going to create a separate investment using my 3-bucket strategy. I'm going to show you how my channel's doing, the money I'm putting into these investments, and the results, and share that with you all in like a vlog type format. Leaning right now towards Fidelity, but you know what, we'll see when we get there. So I hope this helps. If you have any questions, let me know. Love your thoughts, and please give me a thumbs up, give me a like on the video. I really appreciate it. It helps me with the algorithm.